all eyes on U.S. rate inflation. So how do you project inflation in the U.S. based on your perspective? Do you think it will be remaining a downtrend?
Yes, I do. The consensus for headline inflation is 0.2% month on month, and year on year is 2.9%. Core inflation is looking at 3.8 and month on month 0.3%. However, I think we're going to set the stage for a positive surprise, meaning inflation will come in lower than expected this morning. And the reason we believe that is last month was an exceptionally low base, so that's why we moved up a little bit. This month, the base is higher for inflation. It sets the stage as we move from goods disinflation to services disinflation. I think we're going to see more weakness in services. That headline number could, in fact, come in lower than the consensus of 2.9%, setting the stage for a positive surprise. And if you look at 10-year yields at 4.2%, whereas last month we came into the print at 4.0%, I think it does set the stage for a positive surprise with lower than expected inflation numbers today.
But do you think still gradually to reach the target 2% in terms of the U.S. markets, and also the employees still strong?
Yeah, I do think that we are going to move towards that. By our calculations, we could see headline inflation numbers below 2.4% by March, before the March meeting. And that will be a tricky situation for the Fed because, on the one hand, Jay Powell has said if we wait until it actually hits 2%, it will be too late. So if they see that services inflation starting to come down over the next 2 months, I think the surprise may be, in fact, there is a possibility of them cutting in March, and no one's positioned for that. Keep in mind, forward guidance is all they have as a policy tool. So right now, forward inflation, 5-year inflation break-evens are at 2.28%, very close to the Fed's target. What you will find with the Fed is they will continue to talk hawkish until the day that they cut. There will be no warning, Andy. They will not say, in about 3 weeks, I think we could probably cut. We're getting close enough to the target.
But previously, the Fed signaling will cut rate start in the second term in this year.
I think they could do their first cut as soon as March, even though consensus is closer to June. I think the numbers that we're going to start to see today, next month, and in March in particular, that they're coming close to the target, and that will give them a kind of a coin flip in March. If not March, May or June for sure will be the first cut based on the numbers we're looking at.
Mm-hmm. But how do you think about the U.S. employees rate? It's still hard to tame as a U.S. rate is not to cut rate in this first term.
Yeah, in terms of the unemployment rate, it's still very low, but what we're seeing is inflation can continue to come down even in the face of good employment numbers. Inflation has steadily dropped. It's going to continue to steadily drop. And the secret here, Andy, is going to be services inflation, which have been sticky, starting to come down this month. And when we see that today and in the next month's report, that's going to put more and more pressure on the Fed to cut sooner than everyone is now anticipating. And I think expectations are very, very low for a cut in March that I think is more than a coin flip at this point.
All right. The Fed probably won't cut rates in March. So how would it impact the bond market?
Well, that is the market consensus that they won't cut in March. I think that the positive surprise could be that becomes a possibility. In terms of bond markets today, going into this cut, as I said, last month, 10-year yield was at 4%. Now it's at 4.2%. So expectations are very, very low in terms of inflation getting a lot better in time for the March cut. I think we're going to see some data today that shows us that inflation is falling a little bit faster than expected, in which case you could see bonds start to get bid and yields start to compress because no one's really positioned for the possibility of a March cut. So keep in mind, if those inflation numbers come in softer, less inflation than expected, you're going to see a bid in bonds and a compression in yields, with people starting to think maybe, in fact, the Fed could cut in March or May, despite the fact they're saying that they're not. If the numbers continue to come in better than anticipated, they will have to move sooner than June.